Hi everyone, welcome to GloryHouse Podcast. Today I'm interviewing Urs, one of the 3 founding partners of Partners Group. Partners Group is a preeminent global private markets investment manager. Headquartered in Zug, Switzerland, the firm specializes in private equity, real estate, private debt, infrastructure, and royalties. As of early 2026, Partners Group oversees $185 billion in asset under management. Distinct from traditional asset managers, the firm is defined by its active ownership philosophy, a hands-on approach to managing assets to drive long-term value. A true pioneer in the industry, Partners Group was at the forefront of innovation 20 years ago when it launched its first evergreen fund structures. While much of their capital is managed through bespoke institutional mandates for the world's largest investors, the firm's core mission remains centered on strategic asset allocation and long-term capital appreciation. Welcome, Urs. It's a great honor to have you here. I know you're a frequent traveler to Australia to visit local investors and share your market insights. So maybe we'll start with the story behind the firm's founding. 30 years ago, I understand you and your other 2 partners left Goldman Sachs. What motivates you and what particular market opportunities did you see at that time?
Yeah, we were all 3 at Goldman, pretty young, 27, 29, a bit older than 30 years old. We left because we wanted to be independent. There was one thing. And we wanted to do something for entrepreneurs. Our idea to do asset management for entrepreneurs. But we very quickly found out that entrepreneurs were bored with just stocks and bonds. So they wanted to do something more about it, and this is how we went into private equity, where we are much closer to the corporate actions overall. And this is, that was when the start was. Yeah. We didn't imagine that we're going to grow to 185 billion. As a management firm is over 2,000 people. We were just 3 of us in a small office back here, but that was the journey.
You said, an office with 3 employees, and look at you now. That's very impressive. And it's a great honor to attend your AGM. What struck me is your motto, build differently to build differently. So how do you maintain the startup culture, the innovation, and how do you, drive excellence in your investments by that?
Yeah, I mean, the thing is, when we started doing private markets, our friendly US competitors, these KKRs or whatever, they were already around since 15 years, so we had to do things differently. So we did lots of things different. We were having at the beginning the first capital protected private equity products, because back then the European pension plans were afraid to invest in private markets. So we found Swiss Re to reinsure this, and then from there we started to do these evergreen structures. Back in 2001, we did the first evergreen. That was actually not for high net worth.
Everyone's doing evergreen.
Every now, 30 years later, everybody does it. But back then, we actually not even did it for high net worth. So family office, we did it actually for institutions. Because the Swiss and German pension plans were not allowed to invest in non-liquid assets. So we made this asset semi-liquid, as these evergreens are. So we invented this. We were the first private equity firm going public back then in 2006. So we did many things. We were the first. The first, we said, managed accounts for institutions, the first to have evergreens and so on, many things. We were the first ones doing it.
And in this current market, what other innovations do you have to build the asset resilience, especially in the market volatility and the higher interest rate environment?
Yeah, I mean, we are also starting, we started with private equity, then private debt, private infrastructure. The newest addition is private royalties. Why royalties? We started to do it in our family office, our own ones, and have given it over to Partners Group now. This is a newer asset class where in royalties you participate with a percentage on a revenue stream, on pharma IP, or a music asset, or a gas asset. The beauty about this asset class, completely uncorrelated. It's going up every year so far, knock on wood. We started to do this in 2019. We never had a negative year. Even 2022, we were up over 8%. which shows that this is really low correlated. It has an inherent inflation hedge, because when you have inflation, prices go up. When prices go up, revenues go up. When we have a percentage of a revenue stream, then our returns are also going up. So
also good cash flow, huh?
It's a high cash flow. So we run this as well as an evergreen, which is very interesting. So people can come in on a monthly basis, go out on a quarterly basis. It's a good addition in asset management for a downside protection. You can expect something like 10-11% return, which is great.
Exactly, especially when there's left-wing events. I think gold falls, Bitcoin falls, bond falls, equity falls, everything's in one direction. So it's really important to have.
Then it's good to have non-correlated assets.
Great. And also I know Australia is one of your most important markets globally. Why do you see Australia, I guess, is on your priority list? And what sort of differences do Australian investors have compared to, say, European or US investors?
So first of all, the whole superannuation funds here, the pension plans in Australia are still growing fast. Many of them have developed private markets over the last. We started to come here in 2010, 11. Since then, they have building up their private markets portfolios from maybe 2% to 10, now 15%. So we were growing with them, with our mandates, because very tailor-made mandates for the institutional clients. That's one part. We even have our largest mandate globally here in Australia. One of the superannuation funds has now over 6 billion managed by us in a private equity portfolio. But then as well, the private wealth market, family office and independent private wealth managers really like our evergreens. We were the first. At the beginning, it was only our evergreens. There were no others. Now we have 5 evergreens in the market here. So a private equity one, a private credit one, an infrastructure one, a royalty one. So we have the whole range of different evergreens. And it's we have over 10 billion Australian dollars just from private wealth in evergreens. It's big. It's very big for us.
Yeah. And speaking of institutional investors, I think, the smart money, the pension funds and the sovereign wealth funds, you manage mandates for them, right?
Yeah.
So in this environment, where do you see how they allocate money and what asset class are their priorities?
Yeah. I mean, first of all, what's important is at Partners Group, it doesn't matter if you're in the evergreen or if you're a big mandate client, you get exactly the same deals. So whenever there is a transaction in private equity, it's going to be pro rata allocated to the big sovereign wealth fund as well as to our private clients. That's guaranteed. Everybody has the same deals. In terms of what people overweight today, definitely infrastructure is a place where people put more money in. The reason for that is the infrastructure. There is so much demand for investments. It's huge. It's also growing over the next 10 years, or 4 to 8 times, because of digitalization, decarbonization. The Western world governments have no money, so they need private money. So it's a big, big growth. And the market is not yet as saturated as it is in private equity. Like we manage 40 billion in infrastructure, one of the top 5-6 players worldwide. Private equity, you have 100 groups, so have 40 billion and more. So we have a lot of possible transactions, but not so much money chasing it. This is always interesting. And the supply and demand is in imbalance in our direction, then you find great transactions.
And do you see in this bipolar world a lot of money is chasing European assets, or it doesn't really matter?
No, it's globally. I mean, first of all, our investment teams are global. We only where we don't invest in Africa, but the rest we are investing around the world. Europe, Asia, US. We are agnostic. We're not saying we want to do more in Europe or more in the US. It very much depends what kind of assets come along, and we are a big believer in so-called themes. So we have themes like in private equity, we have different industry teams. So we have a servicing team, we have a goods and products team, an IT team, healthcare. And in each of these sub-segments, we have themes. Give you an example. We had the theme on the servicing side, pipeline servicing. Why? All the pipelines worldwide get old. The regulators force the pipeline owners to do as much service as possible. And then we said, okay, let's look for the best pipeline servicing company. We found one called Rosen, was owned by a 78-year-old man. He was the founder. He approached him. He said, I'm still young, I'm not selling. We were 4 years behind him, and 2 years ago he then turned 82. Finally agreed to sell us the company. We really love this company. We implement now AI on this company as well. So, the EBITDA has really nicely grown. And so this is what we do. We look for a theme, and then we look for the assets that we like to own. So usually we have worked 3, 4, 2, 3 years on a company before we buy it. And so we know everything about it. We know management, we know the business plan, how we want to develop it.
Yeah, and I remember in your AGM, because you had 2 case studies, one of the investment committees for the infrastructure asset, right? They really know it inside out, every single details.
This is the main reason the private markets outperform public markets. We call ourselves a legalized insider, so we know more at the time of investment of the company, and afterwards we are much better aligned because our management has to buy into the shares. They themselves have to be entrepreneurs. Our CEOs, CFOs, they don't get free shares. They have to take their own money and invest, and then they get something which is called sweat equity. So if our investors make 2 or 3 times the money, with their investments, they make 6 or 12 times the money. So they're very much incentivized. Very aligned. If it goes in the wrong direction, they lose as well. So they lose big time themselves.
Yeah, that's good. I guess for high net worth investors, a lot of people, the money is still in public equity and they've enjoyed good returns and good growth. What sort of psychological and strategic shift they need to make in terms of liquidity and long-term value if they were to invest into private markets?
Yeah, I mean, in private markets, you're not trading, you're not going in and out. You believe in it. You believe that these companies are better managed, what I explained before. Long term, you see the outperformance is substantial of our evergreen, like towards the stock market, over 40% over the years with much less volatility. It's something, these private markets, evergreens, is something you put into your portfolio and you leave it there. And then you are happy, let's say in the royalties, as I said, 10, 11% every year higher compound. You should not underestimate the compound effect. If you, let's say, even our private equity evergreen since 2007 has an average of 10% per annum. So people say, only 10%. I hear these big IRRs of private equity, 20, 22%. But you are, from day one, fully invested. So invest compounding 10% over 10 years gives you a multiple of 2.6 times. So you make 2.6 times your money in 10 years. That's not bad. A buyout fund to get to a 2.6 multiple, and we eat for multiple, not from IRRs, need to do an IRR, a net IRR of 22% to get to the 2.6, because you're not fully invested constantly. Your money is drawn down, you have to send it back. Here with our evergreens, you invest, it compounds from day one on fully. Yeah, patience will be rewarded. Let's talk about your family office. You're very humble, but you're a billionaire yourself, made all very successful business. And from your family office perspective, how do you invest for yourself? My asset allocation is 50% public stocks, 1 stock, Partners Group. It's a nice stock, quite volatile, but it had a good run over the last, since we IPO'd at 63 Swiss francs, and now we are more than 10 times higher, 800, 900 Swiss francs. But quite volatile. And then I have a 25% allocation of my wealth is a mandate with Partners Group in infrastructure, private equity, private debt. There I can over or underweight in the build-up of the portfolio with my portfolio manager. I get all the deals that our clients get as well, pro rata. But I can say I want to do more in private debt or less or nothing in private debt. So that's this part. And then in 2013, we started PG3, the three founders, our family office. And there we do non-correlated asset classes. So this family office knows this is something they can never lose money. Never. There's no excuse. Interest rates up, down, stock market 30% down, oil up to 130. No excuse. They have to bring with these asset classes every year a return. And these are insurance finance is a very niche special asset class where we have insurance specialists in there. Since we started this 2013, we have made 13% return on this in euro terms. It's a euro-based product. Then we do litigation finance, so financing of court cases. It's as low correlated to the Nasdaq or to stock markets as it can be. Either you win the court case or not. There we have specialist lawyers, a lot of people out of the lawyers. We have over close to 70 investment professionals. So there's lawyers, and then the last one is royalties, which now Partners Group has taken over because this is a very big asset class. Yeah. But all three were in 2022 between 8.7 and 11.5% up. So 2022, where everything else was down, at least this 20% of my portfolio was stable, and I liked it.
Yeah, you have a really good team there.
Yeah.
Great. And I guess, last question, if you were to give one advice to first-generation entrepreneur on how to protect and grow their wealth in the next 50 years, what would that be?
The first thing that you really have to take into consideration is how AI is going to affect corporate world. So you should really think about which companies will suffer through AI and which are not well run, and which one get a lot of tailwind through AI, because a lot of sectors are very interesting. So I really would watch this. But the other thing is what I said before, diversify your portfolio. Don't put all eggs in one bucket. We have a huge AI bubble on the public markets today. Watch out for this. I mean, there will be lots of money destroyed in the public market. I don't know when this bubble bursts, but it will in the next 2 years. So don't put all your money into this. It's almost like the internet bubble, just with 1 zero more today. Companies are 300 billion, 500 billion. Some of them will make it, but many don't make it. Diversification is the best thing. That's what I do. 20% in non-correlated, 25% in private markets, and the rest in different other sectors that you like to invest.
It's a nice balanced portfolio.
Yeah, exactly.
Yeah, great. Thank you so much, Urs. Thank you so much for your time. Thank you.